Welcome, everybody, to the webinar on college financial and merit aid and subtitled How to Send Your Child to College Without Breaking the Bank. I'm David Haas, and with me is also Mike Dunn, and we will be your presenters today. We have a service called College Money Match. We basically help you navigate college finances, and the objective is you're going to pay less for college, keep the debt down, which is a serious problem, try to maximize either needs-based or merit aid, understand how much college costs per college before applying, and make a plan ahead of time, which is one of the most important aspects. The idea is we don't want your child to be paying their expenses forever, and we don't want you to be paying those expenses into your retirement. And we are fiduciaries. We're a registered investment advisor, and both Mike and I are CFPs. But most of what we're going to be talking about today is purely informational, and hopefully information you will be able to use. First of all, a little bit about us. My name is David Haas. I founded Cereus Financial Advisors in 2015. This is actually my second career. I started off as an engineer, and so I'm very analytical. I look at everything from an engineering viewpoint. I always tell everybody I have an engineering brain, which is very much a problem-solving brain. I help clients with retirement planning, college planning, investment management, and we developed College Money Match to help parents make better college financial choices. I have two kids. I put them through college, Gettysburg and Syracuse. That was a few years ago, and boy, I wish I knew then what I know now, because I made a few mistakes. So you guys get um, to benefit from my mistakes. Mike, why don't you introduce yourself and then take it from here?
Sure, sounds good. So good evening, everybody. My name is Mike Dunn. Just continuing with the background, I joined Cereus some years ago in 2018. It's second career for me as well. I've got a background working as a CPA and in various banking and alternative investment jobs before I became a CFP and joined Cereus. As with David, I have two daughters as well who we put through college and grad school and one through medical school. And it's nice to say that we did all that, but I will say, as David said, I made a mistake. We have a slide further back in this presentation that talks about um, uh, common mistakes when filling out a financial aid form, the free application for federal student aid, what was known as the FAFSA. I didn't fill that out at the time, and it could have given us some other options to consider. I will say that hopefully with us describing our mistakes, hopefully you will learn from that and not incur or encounter the same things. So here's what we'll be talking about tonight. If you'll move to the next slide, David. Oops, sorry. Before we get to that, College Money Match are the product that we created to help people plan for handling their college expenses for their students. We're not just financial planners, as we talked about, we're parents who've gone through the process and as we described also and made mistakes in the process. So hopefully that will be to everyone else's benefit. We want to help you find the right college for your child, and hopefully you won't find yourself in the position of saying, "Hey, if you get into such and such a school, we'll figure it out." We'd like to have you help you figure that out before you get to that stage. So here's a brief outline of what we'll be covering tonight. I'll be talking about needs-based aid, which generally is formula-driven and data-driven. There's also merit aid, meaning scholarships, academic or otherwise. We'll talk about student loan programs, recent rule changes in financial aid, and then if we have time, we've got a couple of case studies showing how we've been able to save clients money. Hopefully we'll cover at least one of those, but you'll see them in the slides, and you can always revisit with us afterwards, and we would be happy to walk you through that if we don't get through it tonight. So there's been a lot more confusion lately. The Trump administration has made a number of changes that seemingly have caused a situation like the one pictured on the left side of this slide. Um, so the federal financial aid system is administered by the Department of Education, but the Department of Government Efficiency made a lot of cuts. So the workforce for the DOE has basically been cut in half, from a little over 4,000 to a little over 2,000 in a short amount of time. And the philosophy has become more like this quote from the executive order that President Trump signed. The Department of Education is not a bank, and it must return bank functions to an entity equipped to serve America's students. With that, there have been some rule changes around student loans qualifying, and perhaps some limitations on the amounts that people can borrow, which we'll touch on a little bit later in the presentation. And in the current situation, among people looking at applying for college, there may be some legitimate fears in the minds of immigrant families. Let's say the student applying for college now may be a citizen, but one or both of that student's parents may be undocumented, people here in the States. And does it raise fears of, immigration issues being raised if they go through the standardized federal process and perhaps shine a spotlight on themselves? So that may cause some hesitancy there. Also, there are some changes to how Pell Grants are calculated and awarded. Pell Grants are federal grants that don't have to be paid back, that are generally issued to, I think, what they describe to be exceptionally qualified students. And in this case, exceptionally means exceptionally low income. So there are some changes to how people can qualify for that, which we will hopefully touch on as we get through this a little bit later. So have the rules changed for how you apply for financial aid? Generally, no, despite the confusion that seems to have been raised. For the next application period, the 25-26 school year, you will apply business as usual, and I'll walk you through how that's done in a couple of minutes. Begins with the free application for federal student aid, or the FAFSA, which will become available on October 1st. So the FAFSA that people will fill out this fall will be for students entering or returning to college next fall. So fill it out in 25 for the fall semester of 26. And the FAFSA references income information of the parents from 2024. So not to confuse it with too many dates, but there is a long lead time to apply for financial aid. Let's say your student is a senior this year, graduating in June, entering college next fall. You're applying almost a year in advance for financial aid for that student. So if you gather a group of students, 5, 10 students, everyone's situation is unique. Everyone's got a different academic record. Everyone comes from a different financial background. If they're all applying to the same school, you start with the very high listed cost of that school, the cost to attend. Some of those students may apply for, may qualify for financial aid for needy families. Others may qualify for merit scholarships, or other, as we call them, discounts, arriving at their price. And it's very likely that among that group of students, each single one may be paying a different price. Hopefully they're able to maximize the discounts that are available to them. so that you arrive at your net cost. And we'll walk through some programs that hopefully help those students arrive at that. So we'll divide the next couple of sections into needs-based financial aid and merit aid. I'll cover the needs-based portion of it, and then I'll turn things over to David to talk about merit aid and the subsequent loan programs and case studies. So as I mentioned earlier, needs-based financial aid is mainly formula-driven. It depends on data, income information that is actually automatically uploaded from to the federal financial aid system, to the FAFSA, from parents and students' income tax returns. So we'll move on to the next slide, please. So the formula-driven process kind of works like this. As your financial information is entered into the FAFSA, it'll be processed and will give you a result that will be called the Student Aid Index. And it's basically the system's idea of what it thinks you can afford to pay. It may be very different than what you think you can afford to pay for college. This used to be called the expected family contribution, but they changed the term a couple of years ago. Generally speaking, they'll give you a number, your student aid index, and colleges that you apply to will evaluate that. Colleges will make financial aid offers. Generally speaking, we don't expect colleges to offer to cover 100% of financial need. And just as an example, according to published statistics, Gettysburg College, the estimated cost to attend in 2025 was nearly $90,000. And their statistics show that 90% of a family's need was met by a financial aid offer from Gettysburg. And included in that is 80% in grants, the best form of aid because you don't have to pay that back. And the experience that we've had with our software, which we work with actual cases and help people apply for financial aid, the results that we see in our system seems to indicate that Gettysburg has only met 25% of need in the cases that we worked on. So generalized statistics may differ from your actual experience. So as mentioned, financial aid can be, besides grants, can be in the form of loans or work study, jobs that you get to work on campus to help pay for school. The aid can come from a number of sources, the federal government, state government, or the school itself. And for needs-based financial aid, you have to reapply for that each year. Okay, so breaking down the formula-driven process for this, there's two methods that schools will use. Most state schools and some private schools use what they call the federal method. It begins with filing the FAFSA. FAFSA determines what the student aid index is for the family. You have to submit a FAFSA if you want to qualify to borrow under the federal student loan program. So let's say the FAFSA determines that you have a very high student aid index, meaning that the family is expected to contribute a lot to the cost of the student's education. Federal student loans are still available to apply, and in order to qualify to apply for those loans, you will have had to have completed the FAFSA. What the FAFSA looks at in terms of parents' and students' financial information, most things except they won't include the value of parents' IRA accounts, 401k accounts, or the value of the parent's home. And a recent rule change, they used to consider if the parents owned a small business, they wanted the parents to input a value or estimate a value of that business, and they would consider that in the student aid index. They're no longer doing that, so that's excluded from the federal method. The other method is called the institutional method, used more by private colleges, and it involves an additional form provided by the College Scholarship Service, the CSS profile form. So the information that is input to that form is more than what the FAFSA asks for, and each college that uses the institutional method has their own kind of black box in terms of what they'll consider and how they determine what they think a family can expect to contribute toward their student's education. So the institutional method is not as generous to parents because they may look at the value of parents' IRAs, 401ks, annuities, home equity, and small business. So this next slide, I think what we're trying to emphasize here is that the formula-driven process puts a heavy weight on parents' income and on students' income. So in calculating the student aid index, the FAFSA process will include parents' income in a ratio anywhere ranging from 22% to 47%. They'll next consider students' income, and you'll notice that it's a high weighting of 50% of students' income, anything that they make over 11,400 for the year. Also a high weighting on student assets, not including a 529 plan. So students are, of course, encouraged to work and save, just as all of us are. Colleges will assume, though, that if they earn and if they own more than stipulated amounts, they're expected to use that toward the cost of their college education. So that's why that's weighted so heavily. And then finally, a much smaller percentage of the value of parent assets is included in determining what they expect a family to be able to contribute. Only 5.64% of the value of parent assets, including 529 plans. So sometimes a question will come up as to, should I be moving assets around so that the colleges won't penalize us for financial aid purposes? And since the weighting of parent assets is very small, it kind of doesn't make sense to think about it in those terms. It's much more of an income weighted calculation. Next slide, please. And then there are some other family situations, let's say, that there are some beliefs about how the FAFSA system considers those versus the reality of how they're actually considered. So I think there was a widely held belief that the custodial parent would be the one that would be evaluated. The financial information would be evaluated to determine the eligibility of a student for financial aid. The reality is that the parent who pays the most towards the child's upkeep is the one that is evaluated for FAFSA purposes. And can the federal program tell who the parent is who contributes the most toward that? It seems you may have some ability to work with the parent that might best suit the financial aid calculation. Under the institutional method, or the private colleges, they actually already look at both parents, so there's no advantage to trying to decide which parents' financial information should be submitted for financial aid purposes. Next slide, please. Another myth, and this used to be a reality, unfortunately, is that you get more financial aid if you have more than one child in college at the same time. Congress changed that a few years ago, very, very disappointingly. And this is for the federal method. So filling out the FAFSA used to be that you'd get, in effect, they would consider an allowance for more than one student in college at the same time per family. The FAFSA no longer considers that. But some of the institutional method schools, the private schools, may give you credit for that. It depends on the school. And yeah, that last bullet point, as I mentioned, FAFSA schools used to allow that discount, and they don't anymore. Very, very disappointingly, and we kind of scratch our heads about that one. Not really sure why that was changed to the disadvantage of families applying for financial aid. I think that covers our overview of needs-based aid. So I'll turn things over to David to cover the merit aid portion of the presentation.
Thanks, Mike. So I'll talk a little bit about merit aid here. And merit aid is money that the college will provide, and it usually is the college, it's not coming from government here, that are not based on income. So they're typically based on the desirability of the student. And the primary desirability is, of course, academics. So they are looking for high academic achievement. That is an easy way to get merit aid. They're looking for leaders. Those are people who are heading student organizations in high school. In many cases, they were looking at athletes. And I'm really now talking about D3. You may get more academic scholarship, believe it or not, being a D3 athlete. I know it's not supposed to work that way, but it shows leadership, and it sometimes does. Um, D1 is something that's really out of our expertise, where the school really comes in and gives D1 scholarships. So that is something very different. Students from certain geographic areas. So if you have a school in New Jersey, a private school in New Jersey, this typically works for private schools. Then if you're a student from California or from Kansas, you might find it a little bit easier to get some money from the New Jersey school. If you're a New Jersey student, it might be a little bit harder because these schools want some geographic diversity, especially if they see themselves as national schools. And then what's very important is showing interest in the school. Going to the school, taking the tours, getting an in-person interview. The more interaction you have with the school is the better it is. The admissions office, and this is very important, they will log every interaction the student has with the school, whether it be virtual or in person. And they want to see those interactions. It makes it easier to get into the college, and it also makes it more likely you're going to get some aid. So you don't always have to be a 4.0 student to get merit aid. The right strategy matters, and the right school matters. Another and very important fact is that you can negotiate. So once you've been accepted, your student has gotten their aid package, you may be able to write an appeals letter. And the reason for the appeal is that things have changed based on maybe another offer. So, for instance, I'll pick on Gettysburg. My daughter went to Gettysburg. So, a very similar school is Dickinson. Um, Maybe the child got into both Gettysburg and Dickinson gave a much better offer, but the student wants to go to Gettysburg. You could write an appeals letter to Gettysburg that the student will go there if only they would match the offer from Dickinson. And believe it or not, that's effective. That works very often. So what that means in applications is you want to apply to some colleges that you know are going to provide a little bit more aid, even if what you really want to do is go to the colleges that are not going to provide as much aid, with the idea that you're going to write an appeals letter later. Um, Appeals are not that useful at public colleges. They just don't have the money. There are public colleges that actually do provide nice merit aid for New Jersey and New York students. But once you get an offer from those schools, then those offers are usually pretty final. But it never hurts to try. The other nice thing about Merit Aid is that Merit Aid is usually renewed automatically. So the student may have to meet some kind of academic goal, maybe a 3.0 or better average. Actually, those requirements have been going down. So, it may be a 2.5 or something. Uh, but you have to, as long as you meet that requirement, the Merit Aid is automatically renewed. One thing that I cannot emphasize enough: families need to create a 4-year budget ahead of time. College is a financial commitment. Undergraduate college is a financial commitment for at least 4 years. And some schools or some programs, it may easily go on to a 5th year. Rutgers, New Brunswick had a 71% 4-year graduation rate in 2025. That is not always because the students had trouble or it's something bad. They may have taken an internship. Uh, they may have done extra study abroad. There's all kinds of reasons why that extra year might happen. And some schools, Northeastern is a good example, actually have 5-year programs. You want to be careful about the debt. You do not want 100K or more of debt for your degree. Now, the government is actually has put limits now on debt. This is new. President Trump's OBBB had the limits, and we'll go over them a little bit. Uh, those are limits for federal debt. You can still take private debt as much as you're able to qualify for. This is not necessarily a good idea. The other thing that we really recommend is having your student be part of the finance process from day one. The best thing is if parents can decide how much money they can provide for the education and give the students a budget. Let the students think about, first of all, how much they might pay in loans if they take out extra loans, and also, what they can afford given what the parents can afford. The days are over that students can go to any college that they want. Unfortunately, the monetary question is very important now. I want to say a few words about 529 plans. They are a great way to save for college. And even if you're starting late, they have certain advantages. First of all, they're counted as a parent asset for financial aid. Actually, Mike said something earlier in his section. He said moving assets around doesn't work very well. That may be true for parent assets in particular, especially because they only count at 5.64% for aid. But student assets count a lot. So if you happen to have assets in the student's name, believe it or not, if those assets are going to be used for college anyway, you can move them into a 529 plan. That is one thing that's very effective at lowering the student aid index. Of course, your 529 should be invested conservatively by sophomore year in high school, but you can still make contributions. You can make contributions to the 529 while the student is in college. Uh, there's a $19,000 de facto contribution limit in 2025. There's no federal deduction for contributions, but if you make under $200,000, there is a deduction in New Jersey, and New York also has a deduction for contributions. And if your student is in college, you can contribute to the 529 and you can take it right back out again to pay for college. And you still get that tax deduction in New Jersey and New York. And the distributions are tax free up to the qualified expenses for the school in every tax year. And it's best to use these 529 plans by dividing them into fourths and then distribute funds over the 4 years of school. Here are some FAFSA mistakes. So the number one mistake is not filling it out when you want financial aid or loans. In order to be eligible for federal student loans, you have to fill out the FAFSA. And filling out the FAFSA is not super difficult. Also, the FAFSA has you log in and you fill it out electronically on the studentaid.gov website. And another mistake is not completing the form completely for both the students and the parents and actually submitting the form. You typically have the student log in first, and the student fills out their portion. Parents can log in as the student and do it. That's very common. And then the parent does theirs. The tax information for the FAFSA is transferred automatically, um, and all that the parents and the student need to enter are asset information and demographic information. Another mistake is reporting the 529 plan as student assets. The 529 plan is a parent asset. So they only ask, they have one line and say, what are your investment assets? And that includes, your E-Trade account, and it includes the 529 plan, and you need to add it all up. The other mistake is reporting retirement accounts. The FAFSA doesn't want to know about your IRA. It doesn't want to know about your 403B or your 401k. So don't put them in. Let's talk a little bit about loans. First of all, the federal undergraduate student loans. So you take these loans out after July 1st in the year that your student is going to go to college. So if we have parents of seniors in our audience, you'd be taking out the loan on July 1st or after July 1st of 2026. I can only tell you what the loans are, what the interest rate is right now. So these are not the interest rates that you will pay. Right now, the rate is 6.39%, and there's a little bit over 1% origination fee. There's two types of loans. There's the subsidized and unsubsidized loan. What's subsidized is interest. So if it's a subsidized loan, there's no interest while in school, plus 6 months afterwards. An unsubsidized loan, you're not actually paying the interest up front, although you could, but it's deferred or capitalized if you don't pay. And actually, there's a maximum of $31,000 over your entire undergraduate um, college experience. 5,500 if you're a freshman, 6,500 sophomore, then 7,500, 7,500, and $4,000 for that fifth year if it happens. So these are the caps. And by the way, these have been the caps for probably about 10 years now. They have not gone up, although college has become much more expensive. These loans are good. It's the first loans that I would recommend if your student is going to take a loan because they are eligible for income-driven repayment plans. They're dischargeable on disability or death of the student. And what loan forgiveness programs we have, these are eligible for them. So they are the first loans I would look at. Then we have the Parent Plus loans. So these are loans in the parent's name. They have a pretty high interest rate. Right now, they're at 8.94%. These are federal loans, and there's an over 4% origination fee. There's a new maximum, and if you are a senior in high school, or your student is a senior in high school, this maximum will come into play for you, and it's $20,000 per school year per student. The loans are only based on credit score and not on income, which means you don't really need to qualify. You just have to have paid your bills and have a reasonable credit score. Um, this is probably a disadvantage, not an advantage, because it lets parents take loans that they really shouldn't. There's only a standard repayment plan. This is fairly new. There used to be an income-driven repayment plan, but the loans that, again, your students or you as parents would take out for your students will not be eligible for an income-driven repayment plan as of right now. These are new rules that were instituted. Then there are state loan programs. I like the state loan programs. I like them quite a bit. So, unfortunately, New York does not have one. New Jersey has one that's really nice. So, a lot of the state loan programs are eligible for students who either live in the state or are going to school in the state. So, if you're a New York student and your student is going to school in Connecticut or New Jersey, you can take advantage of these state loan programs in Connecticut or New Jersey. For Massachusetts, they actually let students who live anywhere um, take these loans out and go to school anywhere. So you might be a New York student going to a New York school, you can still take a Massachusetts state loan out. The reason why I like these loans is that first of all, they work similarly to the private student loans, but they have slightly better repayment plans available. They usually have discharge on death and disability. So this is an example of the New Jersey loan. Um, a 6.5% loan would be a 10-year loan, and I think they have a 20 or 30 year, I can't remember. That's the 8.75%. So as the loan gets longer, the interest rate gets higher. These are actually pretty competitive rates. Um, the student could be the borrower. If the student is the borrower, they need a cosigner, and it's based on a credit score and on income, so you do need to qualify. And there are some income-based repayment plans for New Jersey, but the availability of those varies depending on what state you're in. And there are other sources for loans. There are plenty of private student loans. I personally like the state loans a little bit better. They'd be my first choice or second choice, I guess, after the federal undergrad direct loans. You could borrow on home equity. Of course, home equity loans tend to be quite low in rate compared to the other ones because they are based on your home. So if you didn't pay them back, you'd lose your home. Something to think about. And another possibility, but it's only $50,000 maximum, is to take a 401k loan. If you have a 401k, you can take out 50% of the 401k as a loan up to $50,000 max. So that's not a lot, but compared to the price of college. But if two parents are working, both of them can take out the loans. The problem with 401k loans are that if you lose your job, they're immediately payable. If you don't pay them, it becomes a taxable 401k distribution. I already talked about college choice a little bit. Um, the more prestigious colleges will give you fewer discounts. So that's a psychological thing you need to think about. Um, Everybody wants to go to the very best college they can get into. Well, the very best college you can get into is likely the college that's going to give you the least amount of money in merit aid. So you need to look at that when you're applying for college. You need to think about that upfront so that the student doesn't become really disappointed when they can't go to a very prestigious school. I'll pick on Tufts. Tufts is a wonderful school, very very prestigious. Um, doesn't really give merit aid, so you're not going to get merit aid at Tufts, but you might get lots of merit aid at actually, a good example is UMass. If you're a New Jersey or New York student, UMass Amherst happens to be pretty generous. For a state school, it's unusually generous. So that is a much better price point, and it's a great school. You can predict the financial aid and merit aid. That's what we do. We have software that predicts it. It's on the conservative side, so we want you to be surprised pleasantly and not promised more aid than you would get. And I already talked about thinking about schools that you can use for bargaining. I do want to say something about early decision. Early decision is a bad idea financially. That's a mistake I made with my son. He went to Syracuse early decision. They didn't give him any money. They don't have to because it's supposed to be binding. So if you want a good financial package, early action, rolling admissions, those are fine. Those are not binding. You can delay your decision until May 1st, but you really want to not choose early decision. And budget up front. We talked about that. Okay, I think we have some time for a case study. So this is just an example. This is actually an example for the 25-26 school year, I believe. I didn't update the case study for the following year yet, but here we have Malcolm Morris. Parents are John and Esther. John makes 140,000 a year. Esther makes 30,000. They have home equity. They've been good savers. They have quite a bit of savings and investment, and they've been saving in their retirement accounts. Malcolm's a high school senior in 2025, so he's going to go to college fall of 2026, and he has a sister, Ann, who is 2 years behind. Malcolm has a 3.95 GPA and got a 34 in his ACT, and he wants to study English. Hopefully everybody can see this. This is the predictive data from our software, our College Money Match software. And you'll see a list of colleges that Malcolm applied to. Brown, Gettysburg, Marist, College of New Jersey. By the way, Malcolm's a New Jersey resident. University of Alabama, University of Delaware, University of Rochester. And the COA is the cost of attendance. So this is the listed cost of attendance. And then the SAI, remember we talked about that. That's what comes out of the FAFSA. But it's also a number that comes out of the CSS profile for institutional schools. So the schools with an F, and by the way, I put Bergen Community College in here to make a point that you could be going to community college. Bergen Community now has dorms, believe it or not. So the cost of attendance includes dorms. It's even cheaper if you're commuting from home. That's a 2-year college, so that's another choice. You can go to school for 2 years at community college and then transfer into a 4-year school. It's a way of really saving money. So at their income level, the SAI for Brown is actually pretty low. Believe it or not, it's lower than some of the state schools, than the FAFSA method. And then it's just the way they count things. And then the institutional method SAI for Gettysburg is higher, and the University of Rochester is higher. I guess it's the same as Gettysburg. Yeah. So when you take the COA, subtract the SAI, that's where you come up with the need. So the need is lowest at College of New Jersey because it's not that expensive a school. Again, discounting Bergen Community College a little bit. And then the need is highest at Brown. But then we look at what the actual, we'll skip the grants for a minute, at what the actual first year net cost is. That's the last column. So if you see, the net cost at Brown is actually the lowest. Now, Brown is very hard to get into. It's an Ivy League school. But the one thing about the Ivy League schools is that if you have financial need, they cover close to 100% of that need. They actually claim to cover 100%, most of them. And then you have schools like Gettysburg. Basically, Malcolm's going to be paying someplace in the 40s between low 40s and high 40s, except for the University of Alabama. And the University of Alabama is going to give them a nice merit scholarship. Remember what I said about out of state? They probably don't get too many New Jersey students, and they're going to give him a very, very nice scholarship. If he likes it, it's a great way of getting a good education for a relatively low cost. Let's see. I think we have, oh, so the software also provides outcomes by looking at what the loans might be for going to each of these colleges, looking at what your first year salary is, and then looking at how much of that is going to, how much the loan payment is going to be out of the monthly take-home pay with a 10-year repayment plan. So, Brown is a great affordability profile. Alabama is good. Gettysburg is actually good, but some of the other ones are you have to be really cautious about. And this varies, the salary varies by school. How do we know what it is? The schools actually are supposed to publish this information. They go out and ask their students what they're being hired at, what their first year salaries are for each major, and they publish that information. So that's how we know it. It's coming right from the college. But we're collating it. You can see it in one place. Okay, I'm going to just say Clifford, which is the second case study, is a little bit different. Clifford is also very, very smart, but the parents are much wealthier. So Clifford is unlikely to qualify for any needs-based aid. And Clifford wants to study engineering. So let's quickly just look at the differences here. So SAI is through the roof. Clifford's not going to get any aid, any financial needs-based aid because there's no need. But Clifford will get some merit scholarship. In this case, they're engineering schools here, so the schools are a little bit different, but you can see that the price tag is much higher for these schools. Purdue is the cheapest. If we're looking in the last column here, first year net cost. And if Clifford wants to go to Stanford or MIT, fantastic schools. The nice thing is the salary that Clifford's going to get when they get out is going to be sky high. That's great, but Clifford has to be able to afford it, or Clifford's parents has to be able to afford it. And if we look at the outcomes, you'll see that the first year salary is much higher. It's much higher for these schools. At Stanford, it's 91,740. So, yeah, caution. But actually, for some of these other schools, which seem to be so expensive, like RPI, school I happen to go to, RIT, my cousin happened to go to that school. Stevens, I know a lot of Stevens graduates. These are actually pretty good profiles. Why? Because the monthly take-home pay is much higher. So, the loan burden, although it's there, isn't as high as you think it is. Let's quickly talk about some of the financial aid and loan changes that occurred recently. We already mentioned that the net worth of family businesses with less than 100 employees and family farms and fisheries are now going to be ignored. The fisheries is a new thing. They were ignored prior to 2024, and then for 2 years, 2024, I think, and 2025, they were counted. The truth is, that it's very difficult to ascertain that information. Nobody's going to go and figure out how much they can sell their family restaurant for. Chances are it'll be close to zero. Restaurants are really not worth much. Or the family plumbing business. A lot of these businesses, these small businesses, are really not worth much anyway. So ignoring the worth of the business is probably just fine. Another change that was made is that the Pell Grant is not granted when the student aid index is above 14,790. That's actually double the federal poverty limit. This used to be on more of a sliding scale based on the federal poverty limit. So they've actually made it less likely that Pell Grants are going to be granted. We already talked about the fact that the Parent Plus loans are capped, 20,000 a year and 65,000 in total. So that's important. If you're going on to graduate school now, graduate school loans are capped. There used to be this Graduate Plus loans. Those have been eliminated. They were unlimited, but they've been eliminated now completely. There are new repayment plans for the federal student loans. They're less generous, income-based, an income-based repayment plan, but less generous. That's really the out of scope of what we would discuss here. Um, Another thing is that students who receive a scholarship or aid covering their entire cost of attendance from non-federal sources are then not eligible for federal Pell Grants. So there were always limits to federal grants based on outside aid. They've just changed that slightly. So we're going to conclude this here, and then Mike and I will take questions. So really, you need to ask yourself the question of how will you afford to pay for college? Hopefully you have some savings, but you definitely need to create a plan. If you have more than one child, you definitely need a plan, and you need to incorporate cost into your college search. You need to look at what loans will be taken out. I do have to point out that student loans are not dischargeable in bankruptcy unless there's no hope of them ever being paid off. The no hope of ever being paid off is something like permanent disability. It is not just, I lost my job, I'm going bankrupt. Because they'll assume you'll get another job. Those loans will not be discharged in bankruptcy. You also want to make sure that the college costs of your kids are not going to affect your retirement, because you don't want your retirement plan to be dependent on your children. And this is where our service comes in. This is where we can help you. This is just an example of you probably can't read this at all, of our software when you log in. So our College Money Match is just a combination of software that knows a lot about colleges and helps you do this financial planning and coaching and advice sessions from either Mike or myself. We do have a free giveaway. First of all, a demo, so you can make an appointment with Mike or myself for a demo of our software and our service, and we can chat. No cost. We also have an ebook that's available on our website. There's a lot more details there about student loans and some different tax breaks for college educational expenses. So all you have to do is sign up on our website, collegemoneymatch.com, in order to get that ebook. And now I'd be happy to take questions. Myself and Mike, and I guess we got about 13 people on there. But if you want to type any questions you might have in the chat, or if you really want to ask it live, unmute yourself and ask us.
So we've got a question in the chat. Familiar with FAFSA and the necessity to file that, but not familiar with the CSS. Why would someone else have filled that out, and who would it apply to? What is the benefit?
You want to take that, or
Sure, I can. I'll start, and if you'd like to add, please feel free. So it depends on the schools that your student wants to apply to. Just going back to what we said earlier in the presentation, the FAFSA is generally the only form used by many of the public colleges. So think big state universities and state college systems. Many private schools, in order to apply for financial aid, they will ask you for additional information in the CSS profile form. So you would fill that out if your student wants to apply to certain private schools that require it. And then the benefit is that you'll be considered for financial aid. The CSS profile looks at more information than the FAFSA does, so they may not be as generous as the FAFSA in making the determination of how much they think you can afford to pay. But in order to be considered at many schools, they'll ask you to fill out the CSS profile form. So the
I,
benefit
you
is
know,
potentially
I,
qualifying for aid at a private school.
I guess I would say it's different rather than necessarily less generous because there are cases where the CSS might actually give you a lower student aid index, but the schools that it applies to are more expensive. So because it's typically the more expensive schools that require the CSS. And I would say that if you're, like Clifford's parents, pretty sure that you're not going to get any aid anyway, you still want to fill out the FAFSA, but in that case, you really could skip the CSS. So Megan says, "Hi, I am a small business owner. Does this new omission help or hurt me?" I would say it helps you, if nothing else, with grief, in the sense that you don't need to worry about how much your small business might be worth. So a lot of small businesses, because they rely on the owner, the owner is so important to the business. That's really why they're not worth much of anything. The only thing they're typically worth is the assets. So if you own a business that, for instance, owns a fleet of vehicles, the worth of the vehicles is the worth of the business, and then you got to figure that out to report it. Now you don't need to report it on the FAFSA anyway. The CSS still asks for it. So it's just really less grief. It's a parent asset, so it's counted less anyway. 5.64%. Um, it's more grief than anything else. So we have a question here. Is it a good idea to put a lot of money in a 401k to show the income low for SAI calculation for a high income family? Um, well, yes, maybe, in the sense that it's always a good idea to put a lot of money in your 401k. As a financial planner, I really like it when my clients, or even people who are not my clients, are saving as much as they can for retirement. And that's what the 401k does. So, from that point of view, it's always a good idea. Will it affect the aid? Possibly. You have to be qualifying for aid in the first place. So if you're on the borderline, the answer is yeah, sure, it's a good idea.
I have a question if I can
Sure.
ask. Yeah, actually, I live in New Jersey, and my daughter was, one of her friends. She's just looking for colleges, so she told me though, like if she applies or gets into a state school, a state university in New York, so she can pay the same tuition if she goes to a New Jersey State University, like Montclair State University.
Yeah,
So,
SUNY schools are a great bargain.
okay. They're great. Even if I live in New Jersey, then I'll have to, the price would be more. I have to pay more out of state, or they'll charge me for the New Jersey state.
Yes, I mean, if you live in New Jersey, you typically, and you're going to an out-of-state
Yeah,
state college, you
yeah,
typically pay a higher price, and I believe that's true for SUNY schools as well.
as well. Okay.
But but the New Jersey state schools are so expensive that the out-of-state tuition for SUNY schools for New Jersey students is actually about the same price as the in-state tuition for the New Jersey schools. So that's
Oh,
why I
okay.
mean it's a bargain. I mean, you can look at the SUNY schools and pay about the same as in-state New Jersey.
New Jersey. Okay. Okay. Thank you.
Yes. I guess Matt is asking a follow-up question. Sorry for the redundancy, but just making sure. CSS is a different application document than FAFSA. Yes. FAFSA is a federal form that's found on the studentaid.gov website, and the CSS is a service of the College Board, the same organization that provides the SAT, which is a private organization. So CSS is it's called the CSS stands for College Scholarship Service. It's really meaningless mnemonic, but it's found on the College Board website, and the same login that is used for signing up for the SAT, the College Board login, it's what's used for the CSS. Okay. Tina's asking, hi, I have two children. Is the $19,000 de facto limit on 529 plans per student or total for both? The limit is actually an estate planning limit. It's the annual estate exclusion, and it is going to be per student. So it is not both.
And also, if it's two parents contributing, you double the 19,000 to 38,000 per student.
Yes, I believe that's true. Um, So the CSS form and so Megan is asking, is the CSS form done ahead of time or once the student gets into school? And we didn't really talk about this, so I think this is an important point. Both the FAFSA and the CSS are available October 1st. It is a good idea to do these forms early if you want to get some aid, because aid is a little bit first come, first served. Now, in some cases, you may only be applying, if you're really applying regular admission, maybe it's a January 15th or even as late as February 1st deadline. They're not going to look at the financial information before you apply. Um, so, if you don't do the aid application the first week that it's available, don't beat yourself up. But with rolling admissions and early action, I would definitely look at doing these forms before the applications are sent in. And if you have a question that you want to ask and you don't want to ask it here, feel free to contact us. We will be sending a follow up with the slides and more information, but happy to try to answer questions. I guess we will say good evening and good luck, and I hope we'll be able to help you. And please, let's have a conversation.
Right, thanks for joining
And
us. Thanks for your questions.
yeah, and if you know other parents, obviously, obviously, if you're parents, then you know other parents who are going through the same thing. Please refer them to us. We'd be happy to chat with them. All right. Thanks so much, everybody.
Thank you, everyone. Have a good evening.
Have a good evening.